Beth, this is finance report.
Good morning.
Good morning.
Follow up on some of Fred's comments. And I realize it's been a year since I've been here, and I think I've been before you every month with bad news. And hopefully that will change, but I don't think it's going to be this month. Let me start just filling in a little bit more about what Fred said. Start with some national and then work down to the local. The point of the national being to set the stage for what we're seeing, but also that we're not alone, and it's in some ways our revenue situation is not as bad as elsewhere, although it depends where you look. This month, the Rockefeller Institute of Government came out with a report on statewide revenues, so national, what's been happening to states, and showing a persistent decline in state tax revenues, 4 quarters, double-digit declines nationwide, down 12.5%, which is the worst decline in overall state revenues since the 60s. We also saw in December retail sales were down, which was a surprise to economists. There had been the expectation that retail sales were going to be flat to up this year. And then on the real estate front, again, nationally, we're still seeing difficulties. And one fact that a lot of economists are looking at is that was almost $50 billion of interest-only mortgages originated in 05-06. And those mortgages typically had 5 years of interest only, and then in the 6th year, the payment that individuals would need to make on their mortgages was going to increase. So that means 2010, 2011, we're going to see higher required interest payments. And economists, as a result of that, economists are projecting an increase in the number of foreclosures nationwide up to about 3 million this year. So that trickles through all the implications of that. On the housing front, though, there is some good news. Housing starts were up slightly nationwide last month, and building permits were up significantly, which is a positive sign of a future upturn. And on the employment front, again, nationally, the rate of layoffs has been declining. The national unemployment rate is still at 10%. But last month, again, there was an unpleasant surprise. There was an increase in new unemployment benefit claims, which means more people are out of work looking for, seeking unemployment insurance, and that sort of deflated the hopes of a more quick recovery. I mean, these statistics are month by month, but as Fred said, the outlook both in the state and nationally is not a recovery that goes like this, but a slower return to full employment. Locally, as you probably saw, the state unemployment rate in December is 11%, up slightly from 10.7 in November. And in our counties, both Washington and Clackamas County unemployment rates went up. Multnomah was unchanged. So Clackamas and Multnomah are both at 10.1%, and Washington is at 9.2, up from, it was just below 9% last month. And again, employment, which is the most important indicator that TriMet looks at because it's critical to our payroll tax receipts, declined a little bit in December. So we saw the revised numbers showed a little bit of growth in October and November, a little bit of decline in December. But as Fred said, since last year, we are down in the 3 counties 50,000 jobs. Now at the worst month, year over year, we were down 56,000, 57,000. So there is some marginal improvement. It's going in the right direction, but it's still 50,000 people in our tax area who are not working, who were working a year ago. So as Fred said, unfortunately, we don't have any real change in our prior message and outlook about where we're going, and we are not anticipating or building into the budget a rapid return to higher employment and higher payroll taxes. If you look at the operating statement, if there are any questions about the economy, I'm happy to answer those. If not, I'll turn to the operating statement. We're now halfway through fiscal year 10, and what you'll see is total revenue running about 5% under budget, with passenger revenues almost 8.5% less than budgeted, and payroll tax about 4% lower. Now, the passenger revenue, which is about 21% of our revenue, is below budget because we were just too optimistic about ridership. We didn't think we were last year, but our budget assumed flat bus ridership and an increase in rail due to the start of the Green Line, when in fact what we've seen is bus ridership is down almost 10% since last year. And as Fred noted, a lot of that is peak commuter times, reflecting a 10% unemployment rate. And overall ridership is down about 5%, even with the increase in MAX. Fortunately, if you look at the operating report, our operating expenses are also running under budget by about 3%. We look at this, all the variances very carefully, both the variances good and bad each month, to determine if we're going to have to make further cuts in FY10 to make sure we're looking at where our ending balance is going to be, because our ending balance in fiscal year 10 is our starting point for fiscal year 11. And the variances on a month-to-month basis are hard to, it's hard to take too much meaning from them, because when you dig into them, some of them are due to timing, revenues and expenses coming in sooner or later than budget estimates. And by the end of the year, we expect them to be pretty close to budget. But there are a few expense items which have been consistently under budget and are helping us offset the lower revenues. The biggest savings continues to be lower costs of lift and ATP due primarily to lower usage. We're seeing lower costs in all categories of the ATP, lower costs of the service providers in all three counties, less use of backup cabs, and lower contracted transportation costs. We also have lower personnel costs in operations, in part due to slightly lower headcount. And as Fred mentioned, this has been due to natural attrition, a bit faster than we expected, but not causing, we have not had any layoffs to get that lower headcount. And so far this year, we're also seeing some savings versus budget in our diesel fuel costs and lower insurance claims, although those we watch every month because we don't control the fuel prices. Those can change, and likewise the insurance claims are, we have a budget, we watch it, and we don't assume that the next 6 months is necessarily going to be less than 6 months. So the bottom line is that both our revenue and expenses are under budget, but we're continuing to monitor those to make sure those lines go in the same direction through the end of the year. And lastly, I'm going to turn to the investment report. You'll see about $50 million in our unrestricted investments. This is lower than it was last month, but we do generally see the biggest inflow of cash in the second month of each quarter. So in November, we would expect to be higher than in December because we receive most of the employer taxes, which are paid quarterly, most of them come in the second month. But if you look at the trend, unrestricted balances have been trending lower since we've been in the recession. You'll also see down below under restricted for capital projects, the 2009 payroll tax bond proceeds. Same as last month, $14 million. These are going to be spent primarily on the new communication system, and we have not been spending yet, but next month you should see use of those funds as the contracts are signed and we'll begin the work on that project. And finally, if you looked at the detail behind these pages, you'll see that all of our investments, as always, remain invested in very high quality, highly rated securities, almost all governments and agencies. But the trade-off of that safety is very low yields on the short-term investments. If you have money in money market funds, you know that. 1 and 2 months treasuries and agencies, so money we're investing just rolling over before we spend it or before it's used to pay debt service, has been almost zero. In fact, some actual zero coupon treasuries in that short end. Treasuries that mature out in December 2010, so 11 months from now, are yielding 0.25%, not 2.5, but 0.25%. Agencies are more like 0.3. We have money in the state local government investment pool, which is a pool that the state manages on behalf of them for their money and also for public entities in the state. And that is yielding about 0.68% because they can invest a little bit longer because not everybody can pull their money out every day. We can, but not all of the state agencies can. So that has pulled up our overall yield on our unrestricted funds to 0.3%, 0.32% this month. We do benchmark ourselves against the S&P Government Money Market Fund, which is a very high-grade AAA short-term fund, and that's only earning 0.19%. So we are doing better than our benchmark, but the rates are extremely low in exchange for the safety and liquidity of our investments. Any questions about investments or anything else?